Nirmal Jain, Chairman of IIFL, joins us live. Nirmal, good morning and thank you for joining us. Nirmal, we've seen a solid recovery in Indian markets from the recent low. Benchmark indices are up more than 6%. Do you think worst of the fall is behind us? Has the storm come and gone?
It's very difficult to say, Nikunj, because macro variables aren't looking good. We had a GDP growth of first quarter 4.4%. So this year it's a real possibility that we may end up the year with GDP at less than 5% because things aren't improving. In fact, in the remaining 3 quarters, maybe agriculture will be a positive part of the whole story. But otherwise, things seem that they are aggravating, particularly for corporate earnings. We know that interest rates have been high, the demand is slowing down. So these are not really very positive factors for market to sustain a rally. And also if we see the market recovery, it's more of a short covering and more of the stocks which are beaten down very quickly are recovering. But other than that, most of the new money or most of the new investment buying is only in IT stocks, which again says that investors probably are bearish on rupee and or they think that rupee will remain depreciated and IT companies will make more money there. But if you look at the breadth of the market, then it isn't a bull market, it's more like a bear market.
Nirmal, it's going to be an important and crucial month. We've also got the RBI policy meet and more importantly the Fed meet as well, and the crucial tapering decision is going to be taken this time around, hopefully. How bad could it get if indeed Fed starts to taper in September and we hear a hawkish statement from the Reserve Bank as well this month?
So let me start with how good it can get, because let's be a little bit more positive in a somber environment like this, and then I can come to the negative aspect of it also. One is that the monsoon is good, and probably this is one of the best monsoons in so many years. So we'll have a good news there. And if the Syria war is averted, then the crude oil prices may correct a little bit, which will be a good sucker for Indian economy and our balance of payment. And if RBI, I have a feeling that if you really look at the market in the last few weeks, after the liquidity was tightened, equity, currency and debt, all 3 markets were spooked together. And maybe that was done with good intention, but what it has caused is caused a bit of a panic in corporate sector. It's causing a worry of huge NPAs and is basically stalling whatever little capex was happening. So if those policies are reversed and again we realize that we had followed tight monetary policy with some objective, but that objective has not at all been served. So it's like, you want to administer medicine for some disease, but symptoms are not at all receding and you have other side effects, then the best thing that you can do is reverse, undo and then see how things react. But other than that, in terms of how bad it can get, if you have a bad news on FOMC or I think, the monetary, if our Indian domestic liquidity remains tight, and that means the corporate earnings look even bearish. We have seen that in the first 4 months, 62% of fiscal deficit has been achieved. So government will have to cut down on the expenditure despite election. And if they don't do that, then there's a real threat of rating downgrade. And if that happens, then it can really get very bad, because if our rating is downgraded, the country's rating, then it will become a junk grade. And for junk rating, most of the sovereign bonds fund and many FIs, would not like to invest. And that can actually lead to flight of capital out of the country, which can be negative. In fact, many government people believe that equity markets are stable and the equity money doesn't go out, but that's not true. From the peak, we have seen that $3 billion has already exited of FI equity money on top of $8 billion in debt funds. So I think government and our policymakers will have to realize that given that our imports are more than exports, we desperately need foreign capital. Our FDI policy cannot be consistent because of the political situation, so we depend on FI, debt as well as equity, and they are driven more by sentiment, and you have to take care of that.
Nirmal, at the current juncture, I guess it's very easy to make a bearish argument. Nothing is going our way. But for those who bought stocks after previous crisis, they've made money, whether it's 2008, whether it's 1997, or whether it's 1991. So do you think right now valuations are looking attractive?
Yeah, it's a good question, and I would say that if your horizon is, say, 3 years or at least 1 year, then this may be a good time to buy. And the reason being, India's story is not over. And although India's growth at less than 5% may look bad, but you compare with the emerging markets that India competes with for as destination of capital, then you look at Brazil at 1 or 2% growth. China is has several problems actually. Their domestic debt is very high, growth is slowing down, and it's a command economy, so you don't know when it can implode. Russia has its own problems. So amongst the BRIC nations, still relatively we are better in terms of growth. So I don't think it's a one-way bearish story and people should ignore all the positives. And when and how things will turn around, that nobody can predict at this point in time. But if somebody has a horizon of at least 1 to 3 years, I think 1 year would be a bit of a risk, but if you have a 3-year horizon, you're safer. Then equity, of course, you invest in markets like this, then you make a lot more money. Then you invest when everybody else is investing and everybody else is telling you that this is a good market to invest.
Nirmal, let's look at all the headlines. Crude is at a multi-year high, rupee at a historic low, GDP at a 5-year low, and earnings are growing at a 6-year low. So if anything changes, maybe money could make a comeback because those who are buying right now, they pretty much are buying all the data points. This is extreme pessimism.
Yeah, see, again, if you what you're saying is right, and I may add few things. There are ROE in last 6 years of the corporate India has halved and debt has doubled. So this really isn't a good picture. But the important thing is that market has more or less factored in this, and the money has got polarized into some stocks like FMCG, IT, pharma, and very recently you are seeing only IT stocks. So if you look at the market, there are two important aspects. One is that every sector, every company is different. Sometimes, when the rupee is depreciating, there are some companies that benefit. And similarly, if crude is also going up, then there are some other companies that will benefit. So market has diversity and you can pick and choose stock, in a bottom-up manner. But talking about broader market, when every headline has turned negative, then, one way is that things will now start getting better because everything cannot go bad forever given the Indian economy's fundamental strength, its demographics, its enterprise and everything else that we have talked about for such a long time. So, at this point in time, as you are rightly saying that all the variables are looking bearish and, the underlying sentiment, if you talk about few weeks or few months, obviously is not positive. FIs also, when they look at these kind of macro variables and also the global environment is uncertain, I don't think they'll be enthused to bring in capital soon. But as I reiterate that if you have a little longer term horizon, then India's story is not over. India growth can come back. India can be a good investment destination. And another thing which I'm just trying to repeat is, relatively speaking, still we are not very bad, because the problems are there with us, but there are problems all over. Many times we look at our problems and we think he has caused, or government has caused, or RBI has caused, or we have caused. But fact of the matter is the global environment is such that there is very little anybody can do. So we have to live with those constraints, and within that we have to find the best solution for the problems. Last time when we interacted with you, you had two buy calls. One was ITC, second was Sun Pharma, and then you had a broad buy call on mid-cap cement. Given the way how markets have moved, how rupee has moved, what's happened to GDP, have you revised your recommendation list? Yeah, I would like to add IT stocks. So stocks like HCL Technologies or Infosys, Wipro, Mahindra Satyam, this is a portfolio that you must add in a market like this. Any beaten down pockets which look now, sort of valuable in terms of the valuation because they've been really beaten down, the likes of cap goods, metals for instance, beaten down, but then again you are seeing some activity, or for that matter banks which are again getting thrashed out on a daily basis? I think in a market like this I'll still avoid because I think if I were to come to your channel say 3 years later, then I would have said okay, build a portfolio, but I think I will be interacting more frequently. So at this point in time we can avoid bank, metal and beaten down stocks because still there's no hope which is in the immediate horizon. So I would say that still stick to defensives and stay away from them. If you're a 3 or a 5 year horizon fund, then obviously balance your portfolio and try and pick some stocks. Then I would say that try and pick up stocks where debt is not very high relatively. But for an ordinary investor, I would say still stay away from these sectors. What about other asset classes? For the first time, pain is also visible in the fixed income market. Yes, fixed income market has given negative return and this is a bit surprising. But I still say that you don't have much of a choice because real estate is also not looking too great. I think particularly in a city like Mumbai and where the prices have been very high, the sales have slowed down. The builders are somehow holding the price by borrowing at absolutely unsustainable cost, exorbitant interest rate. So this kind of a thing cannot sustain because you can't pay 24% and say that forever it will get compounded at more than that. So real estate is also not looking great. Gold also seems to have peaked out. And whatever prices we are seeing locally, we should not forget that 10% component is duty. So fixed income, you lose money if you want to trade. But if you're holding to maturity, you still get your interest and principal back. So I would still recommend a portfolio of fixed income to say be 70% of your entire portfolio, and equity portfolio to be dominated by stocks like IT and pharma. I think, and gold and real estate should be there, but should be very minimal at this point in time, because they don't seem to be in a position to give you returns the way they are given in the last 3-4 years.
Innovative strategy, but in such uncertain times, it is better to be safe rather than sorry. Appreciate your time, Nirmal.
Thank you so much.
And certainly hope to see more of you going forward.